Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, where are you coming to us from today?
I am live from the 30th Street station in Philadelphia, famous for when they filmed the last scene of Trading Places. I'm actually on my way up to New York for a client panel discussion at 3:30, and this is the only way we could pull this off to accommodate the great Katie Greifeld.
So in a first, you're going to be sitting on the ground at a train station for us as we record Trillions. It's really like the world is in war mode right now, Eric, if it's come to this. And there's some significant events that have been happening in ETFs that we're going to talk about on today's episode. What's been happening?
Yeah, it's been pretty wild. ETFs are like cockroaches. I mean, they can trade through anything, and they have, even when the underlying is frozen. But we had a situation with Russia where the underlying was frozen effectively, and then also the ETF stopped trading. That's a new one. We've really never seen that before. It's really an important one to discuss, because where does this leave investors, and what should you think about going forward? And then the other one is VXX, which is a VIX ETN, which is Barclays halted creations on that, which it still trades, but without creations, arbitrage is basically destroyed, and so the price deviates from the NAV, and that causes problems. And that we've seen before. That's sort of a classic, I'm a big bank, I don't feel like offering this anymore, let me just halt creations. And that's annoying. I think they're two different situations, but they both speak to this idea of when the ETF stops doing what it does. And I wouldn't say broke is the right word, but becomes impaired. How does that work? What happens?
Joining us will be Katie Greifeld of Bloomberg News. She's also the co-host of the relaunched ETF IQ show, as well as Dave Nadig with ETF Trends. This time on Trillions, when ETFs stop working. Katie, Dave, welcome back to the program.
Thanks for having me.
Thanks for having me, too. I feel bad, Eric, that you had to change things around to accommodate me, because I don't have a lot of answers.
Listen, you're very busy, and I am happy to accommodate you.
You just don't look comfortable.
I'm not. I'm sitting Indian style on marble, and I'm about 4 feet from a Dunkin' Donuts kitchen. But
this is natural habitat for Eric.
Yeah, it kind of is. Back in the day, maybe.
You're going to have to stretch your hip flexors after.
Can I just say one quick thing about Dunkin' Donuts? Pre-pandemic, I would get this same breakfast here. And then 2 years passed because of the pandemic. And then, as you mentioned, ETF IQ started. I came back here on Monday, 2 years later, got the same thing. And it was actually a hair cheaper. So
wow.
Inflation everywhere. Yeah. Although somebody asked me to weigh the food. I was like, come on, I don't think they're doing that. But I think Dunkin' Donuts, that's why they're popular. I think they are able to be more efficient. But anyway, interesting tidbit there.
I could say many things, and we're just going to ignore that and move on. Katie, can we start with you? What has been happening? Because you've basically been on the front lines of the past few weeks as all of these things have transpired.
It's been pretty wild. I mean, it's been a roller coaster few weeks, and I feel like a lot of the action has been centered on a bunch of ETFs that aren't trading anymore. All of these U.S. listed Russian-focused ETFs. Obviously, the VanEck Russia ETF was sort of where all of this action was concentrated. But I mean, as Eric alluded to, none of these ETFs, virtually, I think that's correct, are trading anymore. But before that happened, I mean, you saw a lot of flows into these funds. It's unclear whether that was a create to lend situation, people trying to short it. You also saw options volume take off on a lot of these funds, including a fund, I think it was a direction fund, that announced that it would liquidate, and it was a leverage fund. And you saw, again, options contracts just explode in volume, which we now know, and I'm sure we'll get into. It's unclear whether those holders will actually be paid out.
Okay, Eric, one of the ETFs that we want to focus on is called RSX, which is the VanEck Russia ETF. What happened with that one?
Yeah, essentially, actually RSX and all of them halted creations. That's not that abnormal. Back 10 years ago, the Egypt ETF halted creations when the stock exchange was closed for like 2 months. We've seen this before. We figured, they'll just trade through. But the difference here is this is serious government stuff, sanctions. Also, the stocks stopped trading, the GDRs on those stocks stopped trading, and it became a much more like the ETF was thrust into a geopolitical situation, which it wasn't in the Egypt case. And so I'll actually turn over to Dave because what was different in this case is the exchanges, NYSE and CBOE, said, we're not actually going to let you trade it either. And that was new. I'd never seen that. Normally ETFs trade through anything, even if the underlying is frozen. And nobody writes about mechanics and busted mechanics better than Dave. So I would like to get his take on just what he saw and what he thinks sort of happened behind the scenes.
Well, Joel was sort of saying before we got started that you only have me on when the car crash happens. So it does feel a little bit like that. I mean, you're right that this time was very different. And really, it comes down to the sanctions. I think if you want to trace it all the way back, it's not so much that the Moscow exchange closed for business, because that's, as you pointed out, that happened in Greece, that happened in Egypt. But in both those cases, there was a really legitimate expectation that those markets would reopen. They might price differently, right? The Arab Spring could have gone a couple different ways. But I don't think anybody was expecting that somehow, all of the companies listed were going to disappear. What happened with the sanctions kind of created this, I think, this cascading problem, which is once it became impossible for the Russian companies to actually do business as securities anymore, meaning that they could pay dividends, that they could pay their bond servicing, all of that stuff. When that became a problem, it was really just a ticking time bomb for when the LSE, the London Stock Exchange, would effectively have to suspend the GDRs. And the vast majority of Russian stocks that people trade in London as GDRs, not in New York as ADRs and not in Moscow directly. So once that happened, which was almost instantaneous, that in the early round of sanctions, that it was going to be impossible for these companies to actually do business as global public securities. I actually think they waited about a day late. I predicted on Wednesday 2 weeks ago that they would actually either delist or suspend the GDRs. They haven't actually delisted them yet. I think that will be the next shoe to drop, at which point those no longer become investable securities, regardless of whether the market reopens, if they get delisted off the LSE. So with no underlying security that anybody had faith in anymore, pausing for or halting creations, I mean, that you basically had to do that because there was no way to roll up a basket of securities anymore to do a creation. And then the suspension of trading, that really comes down to the obligation of the exchanges themselves to ensure that they can make orderly markets, right? That's they're on the hook for that. If they let something trade, knowing that it's going to be, hitting the limit up, limit down every 8 seconds all day long because nobody has any idea how to deal with pricing, that is on the exchange a little bit. So, we didn't get it completely synchronized. I think RSX closed for trading a day after ERUS. But fundamentally, you end up in the same position, which is you have uninvestable markets. That's what's different this time.
Dave, in the pantheon of problems, which is sort of how I think about you, you're going to be the red phone on the desk now for trillions. In the pantheon of problems, where do you rank this in terms of ETF history?
Oh, it predates, right? So the last time we can point to anything like this is either Cuba or Iran, both before, both in the 70s and in the 60s prior to that, which was the last time we actually had the opportunity to look at a market and say, this just might not exist when we get out the other side of this crisis. Now, I actually don't think we end up in a world where they actually just obviate all foreign ownership in Russia, but that's on the table. They're already talking about taking over local assets of foreign companies that have pulled out. I think it's really just a matter of time before they say, and we're also obviating foreign ownership of the companies themselves, at which point, literally, those stocks go to zero, right? Those properties get written to nothing, which is incidentally what happened in Iran, and it is what happened in Cuba, which were the only two times in history, I guess 1917 in Russia again. Those are the only times in history that I know that this has happened. So it predates the ETF structure.
So if I'm a shareholder and I'm looking at that, this seems really bad?
Yeah. If you're sitting here with RSX in your Schwab account right now, the very, very high likelihood is that you're going to get some very small percentage of your money back when RSX finally closes, when they finally liquidate it. And, it does have some cash. They did what they could to raise what money they could while those markets were still trading. But at the end of the day, the price you see, the price you last saw is pretty close to what you might get, probably even less. And, as you guys mentioned in the beginning, I actually can't even predict what they're going to do with the options market because that's crazy because the options market now has no way to settle.
you mentioned a word there, liquidate. It's a big, scary word. And I was going to ask, I mean, how does this end? These ETFs where trading has been halted, can that be unhalted? Or do you see this ending eventually in liquidation?
I only think that you'll see the Russian ETFs resume normal trading when you see the underlying markets resume normal trading. And I'm very, very skeptical that that's going to happen for U.S. investors, for a 40 Act fund. I actually think it is more likely at this point that those markets become truly uninvestable, and that even should Moscow reopen, the London will have to delist all those securities on the GDR market, and nobody's going to want to own the underlyings. ERUS had a lot of the direct underlyings. They moved in the last couple of days to put more of the ADRs and GDRs on the books. But even if that reopens at this point, it won't have, I don't think it will have those securities on the books anymore. I think it'll be mostly cash.
So let's say I hold RSX. A lot of people actually bought it after all this happened. Let's say they're trading at $3, $4. They bought it at $5, $6, whatever. It was low. It was $33 4 months ago. So they're looking, hey, it's a bargain. You own that ETF. Wouldn't you rather just have everybody sit in limbo until something gets resolved, even if that's 2 or 3 years, rather than really get nothing?
Yeah, I don't think you'll see them just decide like next Thursday to roll up the fund. I do think you'll see both. I mean, really, we're just talking about BlackRock and VanEck here. I think you'll see them wait until there's a shoe going to drop, right? Whether either we, pass a piece of legislation that makes this permanent in terms of the sanctions, or Moscow does something to sort of obviate ownership, or the LSE delists all the GDRs. One of those kinds of events, I think, has to happen first. You're right. Right now, today is not the day to close down this fund and hand everybody back $1 on their dollar, $1 on their $50 investment or whatever's left over. Why would you do that? So one thing I think is you need to be a little cautious of, though, is I think the idea that these are somehow cheap lottery tickets is really dumb. Like, I don't think that you can look at the price of Gazprom when it reopens as some universal lottery ticket because all assets must eventually be worth something. I think we're seeing a big shift in the fundamental economic order that's going on. So I think that's a bad call.
Russia is not the land of meme stock?
No, I don't think so.
So on the lottery tickets ideas, I remember reporting on the fact that you saw that huge explosion, both in put and call volume, and it was described to me as just that cheap lottery tickets. And I mean, assuming that ETFs hadn't stopped working, I mean, especially for those put contracts, I mean, seems like they would have paid off, though, that actually that wouldn't have been such a bad lottery ticket.
Oh, and I mean, Eric, you wrote about this the other day, right? I mean, there's actually a fairly substantial put-heavy position that's due to settle, tomorrow, I think, on Thursday. I think that's right. $96 million or something like that, most of it on the put side. That should be in the money. Like, to your point, a lot of that should be in the money. But because the OCC changed how they're doing the settlement, where it's now, I think, has to be directed, meaning you have to go in and say, yes, I'm willing to do, I think, a cash settlement on this. I think there are a lot of folks that are going to let these expire with the opportunity to have gotten money out of them. And that's problematic. That's not on like VanEck. That's kind of on the OCC or SIBO maybe, but like even there, we are in pretty untested territory. So I think it's tough to point fingers.
By the way, Dave, you mentioned the Barclays fund. That's VXX, an ETN. What's different about that circumstance than the RSX one?
Yeah, so totally different way that ETFs sort of broke down a little bit over the last couple of weeks. So VXX, for very different reasons. VXX is an exchange-traded note, i.e. it's a piece of bank debt issued by Barclays Bank, tracking first and second month volatility futures. It's the most popular ETF, or ETP, I should say, tracking volatility. It's sort of the trader's darling. It was sitting on about $1 billion. And they suspended creations on it, which we've seen over and over again from ETN issuers over the last decade, to the point where, I know you guys now give it a red traffic light in every situation. And this is one of the big reasons, because it is a little bit of a fit of pique that the bank can just decide they have too much risk on the books and decide to stop issuing new shares, which causes premium spikes, which is exactly what we've seen in VXX. It's exactly what Credit Suisse did to TVIX basically a decade ago. And in that case, they just let it trade to a premium until they got comfortable again. And then they issued a whole bunch of shares out of inventory. And in my opinion, somewhat feloniously, probably booked the profit on that because they were actually issuing out into the market at a high price.
Let me jump in here because these banks, you're right, they do it almost when they want. And that's what's annoying. In this case, Barclays did give some logic. They said, well, we've run out of issuance capacity. But if you look at the documents, they are not out of issuance capacity. They have plenty of runway left. And so some have speculated it's about hedging costs. Some have speculated that somebody made a clerical error with their structured products. And this is sort of part of that fallout. There's also a theory that it could be the canary in a deeper problem with their books. And somebody up management's just like, stop everything. What's your take on what's really going on behind the scenes? Who pulled the plug and why?
Well, so there are rumors I heard those rumors too, that there was sort of a blow up in some structured product issuance that had to get delayed. And that put some strain on the risk desk. And remember, in the sort of a post Dodd-Frank world, banks have to actually manage their overall risk pretty carefully. And so every bank has somebody whose job it is to pay attention to how much Vega exposure do we have, right? How much long equity exposure do we have? How much international currency exposure do we have? And in most cases, they're monitoring that literally in real time to make sure that the bank doesn't get over its skis because they're considered, important institutions by regulators around the world. So it is not unlikely that somebody looked at their book and said, we have way too much long vol exposure on our book for the given volatility environment, even though all of the ETN value of that was offset by an exactly equal liability in the ETNs. That doesn't matter. That doesn't get to be counted because that's just considered short-term paper on the book. So there's an asset liability mismatch in terms of how banks have to account for these things. So it's not inconceivable they just got over their skis on risk. The sort of canard they put up of, well, we ran out of share issuance, that does happen. We know for a fact, for instance, that U.S. commodities funds ran into this on USO and I think on UNG a few times where they literally just didn't file to issue new shares. Unlike an ETF, a commodities pool or an ETN can only sell the shares it's actually registered with the exchange. And when they run out of those, they have to file for more and pay a decent amount of money. So every time they file for one of these extensions, it's like $150,000 to put a bunch of new shares up on the books. Now, it's possible for them to reuse shares that have been redeemed, but most banks don't. And I don't believe either Credit Suisse or Barclays does. So when we look at and say, oh, well, there's 33 million ETNs outstanding and they've got coverage for 50. The problem is if there's been $100 million in creations and $100 million in redemptions, they don't get to count that again. So they actually sort of use up only one side of the balance sheet when they're issuing. We don't actually know. You can't really impute it because the creation redemption numbers are net. So we don't get to really see the creation and redemption. We get to see the net. But I suspect either they let that happen on purpose to get out of this business or the risk desk turned them down.
Something that caught my eye with this VXX situation is just the ripple effects that it could have for the volatility market largely, because I don't know, you might look at the size of VXX and say, okay, it's like $900 million. That's big, but it's not systemically big. But Goldman actually put out a note yesterday noting that if you look at the options market that surrounds VXX, the share count of options is about, or rather the outstanding options on VXX are roughly 6 times VXX's actual share count. That is more than double the ratio of all but 2 ETFs, which is pretty amazing. I mean, it just speaks to that a lot of these volatility ETFs, ETNs, they're used as trading tools for a lot of these volatility players. And I mean, what this means for the liquidity, I mean, how could that options market around VXX be liquid if this ETN isn't really trading or shares are halted?
It's still trading, right?
Yeah,
so that's
or
the
rather
key
it's
thing,
share
right?
creation.
Right. So the share creation just means that it's going to disconnect from its fair value and it's mostly going to trade at a premium. But to your point, you're right. Like the options complex around VXX is huge. And a lot of big hedge funds use that on a very dynamic basis. What you're seeing, if you sort of monitor FinTwit Vol folks, the trader community there, you're seeing a lot of talk about moving to other vehicles, moving to other ways of expressing those opinions about Vega. But that options expiration cycle, both in the VXX and really in the SPY options and the futures, like that really impacts volatility and pricing, right? The whole sort of vol pinning around OPEX is a very real phenomenon. It's less of an issue in the VIX complex than it is directly in the underlying indexes. But you're right. Like it's a lot of shifting around of where that exposure is going to come from. In that shifting around, create the opportunities for hiccups.
One other aspect of this is people who short VXX. So last we looked, there was about 50% of the shares were held short. They haul creations, and man, they screwed them over because let's say you're short this, all of a sudden it starts creeping up because other people who are short start covering. Well, they can't do creations, they got to buy VXX in the open market. That really starts to lift the price quickly, and then you panic, you start to cover. So all of a sudden, you're basically you're in a race to just basically make sure you don't lose too much. Could they sue the company because that's really the product not working as designed? Not that anybody has any sympathy for short sellers, but they made a fair bet and they're getting screwed over.
Also, short interest, it was at 60% according to market numbers. That's enormous.
Sorry, higher. Yeah, that's a lot.
Yeah.
You basically just described the 2015 TVIX lawsuit, right? Which is when, what they got sued for there, which was, we didn't, manage the product correctly and therefore we're liable. Credit Suisse won that lawsuit. So whether they morally should have or not, they won the lawsuit because they had appropriately disclosed everything they needed to disclose. I guarantee you that Barclays is pretty much in the same boat. Everybody learned that lesson, that this is a get out of jail free card, which is, again, why you guys put a red light on this thing, right? Because this is always an option. To your point about all those people who were short and whether they're screwed or not, I guess the one thing against that would be that there are other products out there, right? So, the VIXI exists, right? There is comparable beta exposure available. It's not that difficult to roll up sort of at the hedge fund level an exposure that looks just like VXX. So if you're short, at a 25% premium, you can actually cover your beta on that completely just by buying VIXI or by putting together your own rolling portfolio of those things. So I don't think that there's a systemic issue with that short position being there, but there's no question if you're sitting there on the short side, you have a really tough decision to make. Do you cover up and make it worse, or do you just hang on for dear life knowing that eventually this thing will crash back down to earth?
What would you do?
I'd get the heck out of it. I get a lot of questions from people like, oh, how do I play this premium, blah, 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 blah. And it's like, there are billions of dollars in very sophisticated hedge funds waiting for you to try, just desperate for you to try to play this, Mr. Individual Investor.
By the way, sometimes I tweet about this and most people have this sort of understandable reaction, like, oh, what a mess. But every 10th reply is like, oh, I'm loving this. I don't know what they're doing, but some people just love when
Are they financial journalists? Because this is fun to cover.
Yeah, that's true. But no, these would be people with 35 followers. I think they're definitely on the day trading side.
I absolutely have seen the tweets from folks that were using VXX in sophisticated vol hedge fund strategies precisely because they knew this could happen. Right? This was actually a feature, not a bug, because it only goes one way, right? There's nothing you can do to VXX to make it trade at a 25% discount. That's not how the real world works. That would be unprecedented in the ETF world. But taking something that's an ETN and having it pop to a crazy premium, that's free money for the folks that were smart enough to realize this is just a hanging chad over ETNs every day.
If you were the SEC or somebody who had control over this, or all the banks, you could tell them, would you advise or regulate them to get out of the ETN business once and for all? Or is it okay to have this sort of rated R district where this can happen over and over? You just live with it because, if there's a market, hey, let people trade it. Or do you think it's time to just get them out?
What I'd rather see is for them to allow 40 Act structures to effectively create the same types of things. Like a lot of the ProShares leverage and inverse funds, for instance, are just straight up 40 Act funds because they got in under the wire and they let them manage them that way. There's no reason you have to put this exposure into an ETN. this exposure could very easily be in a straight up CFTC regulated commodities pool. So in this case, I don't see any reason for the ETN to exist. And the SEC's been, they've paid attention. Over every couple of years, the SEC turns the eye of Sauron towards the ETN market and waves their finger a little bit. And to be fair, we are now down to a handful. You and I remember, Eric, 10 years ago, there were dozens and dozens and dozens of all of those E-Trax ETNs that didn't trade. And it was a real littered field of garbage that, all had $2 million in it and never closed. Most of that's finally, thankfully, gone away. But yeah, at this point, I would just think that it's better to shut these things down. I'm not sure anybody's really getting great exposure out of them anymore. And if you want this kind of exposure as a wealthy investor, this is what structured products are for. Literally these kinds of patterns of returns.
Just one more wonky question, but the reason for using an ETN over an ETF that holds the same thing, like VIX or oil, is that the ETN is taxed in a way that's a little more like a stock, whereas the ETF holds futures and the taxation isn't as ideal. So is the ETN popularity really just largely about this tax loophole, or I should say tax standardization with other ETFs?
I think it's two things. So yes, the fact that they're treated as prepaid forward contracts, i.e. they get taxed just like stock, that was a big selling point back in the day, particularly around commodities ETNs before we actually had a lot of the commodities pool ones out there. I think that's largely obviated now because we've got great no K1 commodities ETFs and all that kind of stuff. The other one is frankly perfect tracking, right? So the great thing about VXX, if you're a vol trader running a very tight quantitative strategy, is that you know what the indicative value is to the penny and it never varies, right? It's mathematically guaranteed. When there was a viable creation redemption mechanism and it was trading spot on INAV all the time, that's valuable. And this is a complex strategy with a daily roll. So there's a lot of opportunity for friction and miss on this. So having it in a perfect tracking vehicle like an ETN makes a lot of sense.
Dave, one of the things that I just wanted to ask you here was interesting what you said about ETNs. Anything else that this episode has revealed that the market needs to be talking about more openly and consider changes? Or is this kind of business as usual in worst case scenarios?
It feels pretty business as usual in worst case scenarios. We really do need to make clear that this was a conversation in two chapters. What's going on in VXX and the other Barclays ETN that's shut, which is OIL. That is an extraordinarily unique thing to ETNs issued by the two big banks that really still issue ETNs. And it is the most problematic edge of the exchange traded product landscape. That has nothing to do with what's going on in Russia, even though we are talking about suspended, creations in both cases. What's going on in Russia strikes me as a little bit more like a 200-year flood. I would not have expected to see this in my lifetime, and I don't particularly expect to see it again in my lifetime because it requires, literally the overnight turning of a major economic player into a pariah state. I don't think we're going to see that again in the next 20 years. I hope, right?
Well, you bring up the emerging markets, and we didn't really get to that, but this is why they're called emerging. They are dangerous. The government, some of them are authoritarian. I will say this probably, we've had Perth Toll on her FRDM ETF. Talk about an ETF who keeps getting justified and justified. No China, no Turkey. It really is true. All the problems are from governments with authoritarian sort of, not dictators, but just governments can just do whatever they want. It's an interesting time for that fund. I think it would probably grow after this. But I do think the emerging markets, especially with China, now China is going to be even bigger in EEM. And I don't know, I could feel like the whole emerging markets complex sort of gets unbundled or shifted around. I don't know. Do you think this is a game-changing moment?
I think a lot of people
already said they're killing the acronym BRIC, now BIC. Could be BI at some point.
Yeah. I'm not a big fan of the idea of BRICS or BICs anyway, but yeah, I think this puts a spotlight on what we mean by emerging markets. I think a lot of people, particularly financial advisors, have treated EM as a monolithic bucket, right? It's just a pattern of returns. You put in the corner of your portfolio, you put 8% in it, and everybody's happy. And what we're learning is, no, there's a huge difference between Russia, China, India, Brazil, and all of the other emerging markets. They're all individually very unique. I'm a big fan of Perth product, FRDM. I think it's a really great way to spin this. But I think what we also saw was when all the major emerging markets ETFs had to pull Russia out because the index providers called those Russia uninvestable again, there was a lot of, I think, legitimate hand-wringing there, that the optionality of whether or not those Russian stocks might someday be worth something was being taken out of the hands of an existing EEM or VWO shareholder. That's a legit complaint, but it's a complaint about indexing. And I think that's a really important thing. If you're in an actively managed emerging markets mutual fund right now, they must exist. I can't think of one off the top of my head. Whether or not you're in Russia is a choice that your PM made, right? So that, like, you voted for that PM with your dollars. I don't think most people who just threw money into EEM or VWO spent a lot of energy thinking about whether they were in a FTSE or a MSCI index and what was going to happen on, whether this country was going to get in or out. Like, we talk about it when countries, try to get into the emerging markets, but like this is a big getting out, and that's been a long time coming. We haven't seen that before.
All right, Dave. Usually I ask for favorite tickers. We've done that before with you. I want to ask you, what's your favorite EM ticker?
Well, I already said it. Freedom, FRDM, Alpha Architect Freedom 100. Did I get that right? I don't even remember if I got the name of the fund right, but it's FRDM, and it's it's really the only interesting emerging markets fund out there. It's the only one doing something really different.
Dave, Katie, thanks for joining us on Trillions.
Thank you.
Thank you.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, and wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Francesca Levy is the head of Bloomberg Podcasts. Bye.